Hello everyone, Sherman here. So today I thought I'd talk a little bit about the reason why people are failing Forex. Probably the most blatant reason um, will be this, right? Um, as you see, I'm a straight shooter, so I just come right out and tell you why. The reason is because there's a lot of different strategies out there on trading Forex, right? You have people talking about stuff like Elliott wave, right? Very famous Elliott wave. You have people talking about impulse, correction impulse. You have people talking about maybe harmonics like that. You have people talking about, say, this monthly time frame. Maybe price action has made its way down to the low over here. Then you're supposed to buy. So you have also different strategies like, let's say, an EMA, like so. So every time it pulls back, you buy. Every time it pulls back, you buy. Pulls back to these, when it's above the moving average, you buy. If it's above, you buy, right? So there are many different strategies one person can use. So the main problem comes when a trader starts to hop from one strategy to another. So first, they might think that the EMA is a good strategy one. Then they might think Elliott wave is a good strategy, like the thing 1, 2, 3, 4, 5, and then they're looking for some pullback maybe, or maybe they learned 1, 2, 3, 4, 5. This is an A, it's a B, it's a C. Because once you have a 5 wave, it's an impulse. The correction, there must be one more move up. So some people trade that, right? So this is the EMA one. This is the Elliott wave, right? This is the 1, 2. You have harmonics where they're looking to trade this move up, right? You have number 4. You have something come back previous. This is a major support here, so they think it's going to go up. And maybe when it reaches a high, here they look to sell back down, right? And then some strategy, another strategy, impulse, correction, impulse, first, second, third way, right? The thing is that all these strategies work sometimes. They all have their own failure rate. And when we start hopping from one strategy to another, to another, to another, to another, most of the time, over a period of like 3 months or 4 months, the account will probably have a difficult time um, becoming too profitable uh, because often it starts to get confusing. All right. Now, not to say that if you're really a master of all of them, that's fine. That's fine. If really that good, that's fine. Because sometimes even this strategy here, all right, after it fails, it pulls down. This is going to pull back as well. It's going to pull back as well. So the more strategy a person knows is always a good thing. However, the problem comes when a trader has only traded for only 1 to 2 years, and he tries to learn too much. And once you try to apply everything to so many charts, you probably end up getting very confused. Very confused. Another strategy is also just highlight one, like the kind of gap trading strategies. If I could just highlight one somewhere, I think it was pound. Yeah. See, there's a gap right here. So gap trading strategies is where it comes here, it takes out, pulls back, you find some reason to push up to the gap. This is also a trading strategy. All right. So at the end of the day, which strategy should we use in order to trade? Now, um, I'll recommend, right, for a trader, if you're starting out, say like your first year, you're probably not you're gonna lose your account. So you might as well start trading a demo account that's at least 100K or $50,000 demo account. At the same time, trade a real account of maybe 1,000 and be prepared to lose the 1,000 or 5,000 or even 20,000, whatever that amount is, that real money, you're gonna lose it. I can guarantee you. All right, you're gonna lose it. Take it as money you're giving the market to learn, because um, trading real money also builds up that you don't want your fingers to tremble when you're holding the mouse, because at some point in time when you're going to be trading, you're looking the money roll up and down. It's 100, 200, 1,000, $3,000. You make 2,000, you get back 500. Then suddenly you get back 1,000. Suddenly you get back everything, right? It's negative. And once the account gets bigger, this money, this floating money that you see is complete transaction. It's transient, you see. Okay, so you do have to have a demo account that allows you to see that kind of money ticking up and down. The 3,000, the 4,000 is going up and down, up and down. And then you have to have some real money on as well, but don't put in a big sum. Put in about, I don't know, 1 to 6K, and prepare to lose the $6,000. Okay, that's building up your emotional muscle. And during this time, it's important to just pick one strategy. I think harmonics is one strategy that will show you how to have wins to have wins as well as losses. So the how it goes is it usually goes like this. It's pretty common, right? And then you're looking for this move up. That's all. You're looking for this move up back to the trade two, and right, 86 looking to buy. So all you're looking to this is a setup by itself. So people who trade this way do not worry about wave trading. They're not concerned, or they're not overly concerned about this, because maybe all they're looking for is something like here, and they're looking for this little move up, right? Now this move could also be like this down here. This may not happen. Instead, it flips up that way, right? This is also what they call something like this. So all they're looking for is a move like that, or different kinds of harmonic patterns, like this, right? So all they're looking for is this move. That correct? Yeah. Okay. So they just have to keep it consistent. Now, this move, this move might look something like you see, so price action we have been coming up here like so, then it pulled back to this level, it went up and it went up some, also possible. So in other words, price action did something like this. So it would have some kind of harmonic look over here, and then this one pushes up that way. That is also possible, right? But as an impulse trader, you would be interested in 1, 2, 3. But a harmonic trader would be interested in something that looks more like that. So yeah, like this. And then this looks something like this. So the candles might look also, say, let me see, 1, 2, 3 up like this. Price action came down, came up, came down, pop, pop, and it never broke this low. And then price action, tap, tap, small, goes up that way. So in the end, you get something like an impulse. Then in hindsight, some people might call this a contract, like a little contracting flag. But this one is like an A. Sorry, this starts at 0. This is like an A, a B, then a C, right? So this one never did a complete move. Well, let me see. Well, actually, it did make a complete move from here. 1, 2, 3. 1, 2, 3 like this, right? So it would have looked like something like that. Then if it's impulse, pressure, impulse. But to a harmonic trader, they're looking for this move only, right? So okay, I'm just trying to blend harmonics and wave theory together. But essentially, what I'm just trying to emphasize here is the idea of this, where you just take this, and if you lose, you get stopped out here. So this is your profit. This is your loss. So you're praying that this will move a certain amount before it This one could be going up, or you might even come here and then just continue to proceed down. But as a setup by itself, this itself is a trading strategy. So it's important not to mix up a strategy like this with say support and resistance. So let's say let's go to crude oil. Okay, so on a 1 minute chart, so this is going to crude oil from this, it's going to go up there. I can tell you right now. So today is the 6th of April. So whenever you see this video, know that I said this was going to go up here and fill this gap, right? But okay, so this is strategy by itself. It's zone to zone trading. Okay, but let's look at this one as well. This is another strategy by itself. It is very simple, very simple strategy. But the thing about this kind of strategy is it comes along once in a blue moon, you know, meaning that I posted this video about this video about price action going to the low, and if you took any buys, remember you're not supposed to put your stop right below, because why? Anybody who did that in the past would have been stopped out. So if you were to look to buy anywhere at the lows, you cannot put your stop just below this previous low, because this is a daily chart right now. Because see what happened? It went down and then it bounced back up immediately. Now this itself is a trading strategy, support and resistance, but you cannot keep using this all the time, because at some point, look over here. If you came here thinking this was going to bounce, well, then it failed as well. So in fact, this was looking more something like this. This was a short, strong move, a sideways. So this was a 1, this is a 2, this is a 3, and this is a 1, 2, 3, and this is a smaller subdivision of the bigger wave. This is the bigger wave, 1, 2, 3. This is a smaller wave, 1, 2, 3. Now this 1, 2, 3 could also be a 1, 2, 3, 4, here and 5. So this is like support. You think about a possible Elliott wave. This Elliott wave is within this bigger wave, right? But this is a blend of everything: support and resistance, wave theory, right? You can also strategies like a breakout. You can also take that. So naturally, the more strategies we know, it's a good thing. But in most cases, what really makes success, what really gives a person success in Forex trading is a consistent method that they can use from Monday all the way to Friday, where you can keep trading. You first trade, your second trade, your third trade, your fourth trade, your fifth trade, your sixth trade, your seventh trade, eighth trade, your ninth trade, 10th trade. Once you place these trades, can you come out a winner? So if let's say in 1 month, all you do is in 1 month, if all the amount of trades you have is one trade, and we try to put too many strategies, well, there's a chance that you may not be making money, right? If all you have is one strategy by itself, say this strategy alone, where you just wait for it to come all the way to the bottom over here, all the way to the bottom right here. Then you try to take a trade, comes up to around here, even it goes on lower, you wait for it to come back up here. If that's just the one strategy that you have, hey, that could work. But what would be the main difference is that there's a time factor to it, meaning that you put in your lot size. Remember, lot size is very important. Then you wait 2, 3, 4 months, price will get back up there, right? So this is a daily chart. But what if we don't want to wait that long? What if you say, hey, I see a trade right now on a 1 minute, and I want to make some money right now. We are at the low. But we don't. But you see, in this strategy, this box here was drawn on the daily time frame. You see this one? This was a daily time frame. But if all you wanted was this one to get up there, you're supposed to take your money and go. Because why? This could also come down there. Because remember, this itself, there was strength right here. If price action wants to go up higher, they will come now, take out orders before they can recharge before it goes again. So if you want to take this money, it will get there for sure. Another way is, of course, you could of course come here, then it could go up there, also possible. All right. So people who are looking to who took the buy get stopped out, and then once you get stopped out, they are forced to sell, somebody will take the buy, and then they'll cash out here. Then from here, they can push it down here, right? And then here, people who are in the early buys will then be forced to sell and liquidate their position. When people are forced to sell, somebody will take the buy, and then that's why this one will go up here as well, or even higher. So that's how money is made in these markets, by making someone lose their position, so that the big guys can earn their money, and the cycle goes on and on and on. And of course, we have to make an educated guess where this position, this buy or sell orders are, right? So again, this strategy by itself, as I'm trying to point out, is it's a very low time frame strategy, and it's a setup. It's a setup by itself, right? This is set up by itself, saying that you want price action to ultimately cover this. Now, if you go back to the daily, you can see you cannot even see it on the daily chart. It's hidden within a candle, within this red candle over here. See. So you will not, someone who just trades a daily support resistance will not be trading what I just shared, right? There are people who trade on a very large time frame. They are supposed to be looking at what? They're supposed to be looking at stuff like this, all right? When it broke the previous low, how far did this go before it turned? Okay, about that much, about that much. Okay, it broke a little bit more, just make it more tip to tip, okay? So likewise, you come back up here, over here. This is support and resistance. So this has got nothing to do with harmonics that I drew. It's got nothing to do with this, right? It's got nothing to do with stuff like that. This is supposed to push up, this is supposed to push up. Or it's nothing to do with this, but this is supposed to push up. This is what you make. However, this strategy takes a long time. On the day time frame, it takes so many months before it actually drops, right? So what I would recommend if you're a new trader and you have never experienced getting punched in the face by the market, is to get punched in the face, because defense is more important than offense. Because imagine you're Vietnam and you're fighting the powerful Americans, right? Back in the days of the Vietnam War, you're not able to play the way you're not able to fight the way the Americans do. So the only way you can do is to go underground. You got to fight in a way that is to our strengths. Correct. So our strengths, right, is to be able to play the way where you can have a lot of you can throw as many hits as you can. Throw as many trades as you can. Throw as many trades as you can, and once you have the experience of taking trades and just sticking to one strategy by itself, but taking a lot of it, you will become a much better trader. I promise you. Then once you have mastered one style of trading, then you can actually incorporate this into other strategies. All right. Like for example, one strategy that I've shown, that I shared, for example, a strategy like this one. All right. So, so let's say price action comes down, say like here, 1, 2, 3, and you're thinking this is a 1, 2, 3, correct? Now, if you are a trader that once look for entry, you could wait for entry right here, because why? See, entries like this, usually people take to the 382. A 382. So let's say, oh man, and then let me try to do that again. So let's say it's 1, 2, 3, it pulls back up. So this gives you that look, right? Now this is what they call, when it retraces to around the 786. Around this level here. Let me just put it on. Okay, 786 would be here. Okay, once you reach to this level, you're supposed to take the sell back down. So in this case, you're supposed to take the sell back down, but instead of exiting here, you actually keep it to break the low over here, because your belief is a 1, 2, 3. So by applying the idea of harmonics here, you're able to also implement it into wave theory. Okay, wave theory of 1, 2, 3. Uh, okay. Normally most traders who only play harmonics, you just take this small move and forget the bigger move. But if you can, if once you know the idea of harmonics plus the idea of wave theory, then you're able to go for much further targets. And so instead of just, you know, instead of this, instead of doing this to here, 382, now you're aiming for the break of the low. Now you're aiming for the break of the low right here. So in that sense, you're able to hold on the trades much longer. Okay, so this is blending the short form and the long form. But before we actually think about long form, we must first be able to take these kind of harmonic trades. Okay, so let's just look at any random trades. Let's see if we can find any random harmonic trades over here. So this is a daily. I don't see any. Let's go down to the 15 at least. Okay, so this is one potential one. So right now we have price action. It's hit at least the, let me see, I gotta put all these on. So, okay, so this is what we have. So you hit the 50. So Harmonic says that if this one was to come up to 86, this level, you should expect a reaction. That is what Harmonic says. So then this would now give you a look like that. And when you actually take the trade, you see it's supposed to come back to this level at least. And if currency strength, and if currency, and then if you take this, let's say this happens to not come down weak but come down really strong, guess what? It could even go up further, and then it can also come and pierce this, making this a 1, this a 2, and then this is a 3. So the first trade that you're looking for would then be something like this. Sorry about that. Let me just remove this. So what you're looking for would be something like boom, boom, right? And then this has that look, right? So your entry would be from up here, down here, but you know that this could also get down there. However, you should always take some profit first and see if you can let the rest run. You take enough profit in order to cover, so that you can keep your stop loss a bit higher, so the trade becomes free. But you know that this itself is a very good trade. It's a good trade to get to here. And then once you're able to take off some, so that you can keep your stop loss, because you don't want this to come up here and then take you out. Remember how people actually make money in the market is to stop traders out from the original position. So keep your stop loss here, but even if it goes up there, you will not take a loss. So preservation of account is the most important thing. So what you want is, if it comes here straight down, that's fine. If it comes here, shoots up and down, that's fine, because what you want is a peace of mind trading. You want peace of mind. So harmonics would be something like that. So if this happened to come out all the way there, it's a trade that you are interested in, right? Yeah. So this is harmonic. So let's go look for some other harmonic patterns. And the reason why I talk about harmonics is because being able to take a lot of trades is crucial to an active day trader. All right. You must get into the idea of having streaks of wins and streaks of losses. And even if you win by just a small percentage, not in terms of the number of wins, but let's say you might lose the first 2 trades and you win the next 2. But if the next 2 you win a little bit more, so if your risk reward is just, let's say, you just have to win a little bit more, everything will be fine. So let's say like this, right? So we just make it 1.1, just a little bit more, okay? You see, this little bit more will still cause your account to grow. You see your account grow week by week, all right? So if you lose, you lose this amount, but you win, even if it's, sometimes you might even win more. But if you win even just this little bit amount, you are hit. And because you're taking so many trades, you are going to be ahead of a lot of traders. Believe me, once your account size gets 20, 30, 40,000, you're going to be earning 4, 5K a month. I say there's no problem in doing that. All right. So what I'm trying to emphasize here is take more trades and just win a little bit more. But you must have the ability to do so. Okay. So like here, there's one trade right now. So this is a trade by itself. See that? That's it. So you just have to take a lot of these, get and understand your winning ratios, and then you expect this to go hit the trade too. That's it. Okay. So let's just scroll through all of them and just see and see what we get. So let's see what we got over here. 27044. Okay. Well, I can't say. I'm not sure if this is going to get up there, but if it does get up there, this is a good zone to actually sell down. So then you take the trade too. Okay, this is another one. So in the end, this will have a look like that. See, you will have not the best look, not the best look. But see, the idea of this, right, is this is what it looks like, and the reason for this is because what you actually want, right, uh, is a movement to the downside because of this big move. So what we're saying to ourselves is, you know what? Because price action has moved so far, there must have been a strong. This is the origin of the sell. So I believe that this might get there, but I don't care about that. What I care about is whether or not it retraces this amount or whether it comes down straight down here. Whichever it is, this one or this one, you're going to take it anyway. Okay, you're going to take it anyway. So you're going to take it up to here. From here, see, you're gonna run the 786. You see this level here? Yeah, that's what you're gonna do. You're gonna take it. So I'm not talking about wave theory, even though I try to blend it in. You know, wave theory is what you hope for. 1, 2, 3. But let's forget about that. Let's forget about that. What Harmonics trader is looking for is he's looking for this one. All right, he's looking for this one, and then you're looking for a movement back down to the. That is what you're looking for. This is the type of setup that you're looking for. All right. So let's go through more stuff. So what we're trying to say is just focusing on one strategy alone. One strategy alone, but taking a lot of them. Let's go look at euros on the 42. Standing on the 42. This time frame, I don't see anything. So let's go a little bit lower. Let's go a bit lower. Nothing much here. I don't see anything. Well, on the very low time frame, this one, this year, as you can see. So this is also another trade where if you had taken it, guess what? So on a 15-minute, you would have taken that. So okay, so you got this basically. Basically you got this 80 pips, Euro Aus, right? So just thinking a lot of these trades is it's going to be very good practice. So I'm just going to look at this trade for a while, right? I'm interested in this one to the upside. So I'm looking for reasons for entry. 1, 2. Sorry, this is another style of trading. Breakout trading as well. It's broken up by a little bit. Okay, so I don't want to add more ideas of trading, so let's just focus on one. Okay, so but I'm sharing as I'm trading as well. So this I'm looking at breakout strategies. Okay, so right now let's look at more Euro stuff. Euro, Euro Kiwi. Okay, Euro also we said that this was a winner right there. So we really had quite a number of easy trades. So this one, this one also did go, but this one has to come down a bit lower, like so, before you can actually take the buy. All right. So yeah, a bit lower to 8.6 level. Uh, okay. So dollar yen, you can, as you can tell from this level, okay. So it's already got 270. So when this one comes back down to a previous level of support right here, you will take out these orders that are in the early buy. What happens after that? That's right. Take out those orders and then shoot back up here. So you could put an order right here. Put your stop loss below, and then be at least 1:1. 1:1. So if you risk that much, that's how much you should risk. At least 1:1 or 1:1.1, and then you're looking to shoot to this level. Okay. So let's go at the end. Yeah, get used to taking a lot of these trades. Whether you win or lose, you just take them. Don't worry about it. Aussie yen. So I'm just going to scroll through real fast. So Aussie yen, I can see this potentially going to form. Like you see a strong move down. You see this move up here. 1, 2, 3. You go up. You can also come down. You go up like this. Why? Because then this can potentially do a 1, 2, 3, or you can even do a 1, 2, and then this small move down like that, or even a bigger one. Because then wave theory is going to apply, because you might get something like that, making a 1, 2, 3. Okay, so that is wave theory. Okay, but anyway, if you're talking about harmonics, you're looking at something like this. Something like so. For you to push back, you want to come up here so that it will then give you a look like so. Right? And then because now you get this look, now at this 8.6 level, you're looking to sell it back down. But not to here. Harmonics means you just take it to the 382. Means from here. Right? So so in order to be profitable in Forex, not so difficult, but the thing is being able to stick to one strategy and to take sufficient trades. Right? It's better to stick to one strategy and take sufficient trades. And as time goes by, once we are very proficient in one style of trading, then we can proceed to something else. Right? Let me see. Okay. Just going to pause for a while. Okay, so I'm back. So let's talk about what are the downsides of this strategy. Now, usually what can happen is that when a trader becomes quite good, he knows that, okay, I'm supposed to wait for all this before I actually take this little buy. But what can happen is when a trader becomes quite good, and he becomes quite good, right? And then he's supposed to take this move up. But what happens is when he becomes quite good, he may start to anticipate things, and he might try to he might let's say, how should I say? Let's say this one over here. Let's say, so this one came down, came up, came down, and you know that when it goes up there, you're supposed to sell it down. What happens is the trader might even start to trade this up, okay? Because he wants to trade this up, then he wants to trade this down, so he can make money upwards and downwards. Now, the problem with this is that, as you can see here, it may not always happen. So what happens when price action does not move in a way where it proves these ratios to be true? Well, the short and most succinct answer would be don't do anything. So even though this looks like this, and then when it comes up here, it's supposed to sell, but do not trade this move to the upside unless you understand what wave theory is and you know how to get up there. But getting up here is another strategy of its own. So do not know that when price action comes up here, that's when harmonics comes in. But this move up This move up here, nothing to do with harmonics. It's a style but of its own. And trading this down is a style of its own. So what I'm trying to stress here is that it's like a black box. Every strategy has got its own use and its own time, and you cannot mix them together. Otherwise, we're just going to be stunned. You're going to be paralyzed. You're going to be stunned. You know, if just imagine MMA. So if you know your opponent is not good on the ground, just bring the person to the ground. If you know the person cannot really stand on his feet and punch, and you have a really good right hook, or or really fast jab, and you really like your feet, he can't catch you, then don't go to the ground. Just stick to your punching because that's what you're really good at, and that is his weakness. So just stick to one strategy if you know that strategy is what will allow you to beat your opponent, right? There's no need to do too many things, right? So likewise, once you know that this is going up and you know there is a weakness, that means it is a certain strategy is going to be able to take this move up. In my opinion, it's the breakout strategy. Then you should trade this to the upside just using a breakout strategy, right? And not aim for a 786. Don't aim for a 786. If he gets there, harmonic strategy kicks in. But as this is going up, do not enter hoping that it gets there. Because why? As you can see here, it never got to that level. And when you try to take this up to this level here, you see it broke the low. There's a chance that it might have been stopped out. You know, if they just put like a 1:1 ratio, it might have been stopped out right there. So you should trade a strategy as a matter of its own, and not mix everything together, because sometimes it just doesn't work. And when we have too many strategies, we just get mixed up. No, should I punch or should I kick? Should I kick or should I grapple the guy? And once you get paralyzed, the whole trade just messes up. So yeah, that's something I want to stress. Be good at one strategy and just take as many of it as you can. You know. All right, I think that's really what I wanted to share today, just off the cuff. You know, I hope we can take more trades and just be good at one style before moving to something else. Okay. Well, I hope this helps. Thank you for listening. Bye bye.